Welcome back. Raymond James Financial releasing third quarter earnings after the bell last night. The banking and investment giant missed profit expectations, reporting $1.80 a share. Also, though, reporting revenue was up in line with analyst expectations. Joining us right now is Raymond James CEO Paul Reilly. And Paul, it's great to see you again. Thanks so much for joining us.
Good to be here, Maria.
Give me the backdrop. What drove the quarter, Paul?
Well, first, we had great driving metrics. We have a record number of financial advisors, record client assets under administration, record bank loans. The only thing down a little bit is cash, as clients have put more money into the market, which is a good thing. The thing that hit the miss was really that just our expenses were up on a quarterly basis. We had a number of very large conferences for advisors and other costs, and our advertising costs were up. So if you really look for the first 9 months of the year, we're up, both on revenue, profits, double digit. And last year was a record, so we're up over last year's record first 9 months. So we feel really good about where we are.
What are you going to do as the Federal Reserve embarks on this new phase of cutting interest rates, Paul, in terms of the net interest margin, the impact on your firm, and really the entire industry? We're seeing rock bottom rates. What's your take in terms of the Fed and the impact of the rate cut, which is on the way?
Well, I think a rate cut would have some short-term impact on profits. But, the problem, I believe, is that the rate cuts to the economy aren't the right thing to do. Interest rates are already near a record low. It really doesn't impact, business borrowing costs. So it's, I would think, really a mechanism that pushes the stock market and disadvantages long-term and fixed income investors. But it is what it is. We'll adjust. We have had record spreads. They'd probably come in some, but they'd still be very healthy.
So how significant will the impact be on your earnings? And do you need to clasp down even more so on the expense management as the earnings get hit from the rate cuts?
I don't think it's going to be a big number. It'll certainly have an impact, but our focus is always long-term. The secret to our long-term success is making sure we invest to support our advisors, so we have world-class recruiting and retention for 10 years in a row, less than 1% regretted attrition, and that's what's really driven our business. So we're going to focus more on the long term and making sure those platforms in good shape and not in short-term movements in the stock market or in interest rates, which will change over time.
Paul, hi, James Freeman at the Wall Street Journal. Really interested in your comment, because obviously we hear on interest rates, we hear a lot of constant demand in this city for lower rates. Lower rates, as you mentioned, always tends to juice the stock market. You're not seeing a need for lower rates in the Main Street economy, I guess. And I'm wondering if you could elaborate on that a little, and also tell us, as you look at the European Central Bank getting ready maybe to push rates even further into negative territory, I'm guessing you don't think that will solve their problems either.
Yeah, I don't think, interest rates are certainly a factor, but you look in Europe or you look at here, you're near all-time historical lows. So what do? Go negative? And I do think long-term economic policy would say lower rates aren't going to have that kind of impact. It certainly helps into the short term, but it also artificially, if they get too low, pushes people into stocks because they can get better yields and they can't earn anything on their cash or fixed income investments, which I don't think is healthy long term either. So I'll let the central banks all over the world decide that policy. We'll react to it and help our clients as best as we can through those shifts.
Paul, it's great to have you on the program this morning. Thanks so much.
Good to see you, Maria.
Paul Reilly joining us there, the CEO of Raymond James.